So I'm going to be talking about contingent capital, and I'm actually drawing on two projects, but primarily the first paper here, which is posted on my website, Pricing Contingent Capital with a Capital Ratio Trigger. That's joint work with Behzad Nouri, who's a PhD student here at Columbia. And then some work in progress with Suresh Sundaresan, who's on the faculty here, Zhenyu Wang, who's down at the New York Fed, and Behzad on that as well. So let me give you a little bit of context for what I mean by contingent capital and what motivates this work. So at 50,000 feet, the big question here is how to avoid costly future government bailouts. All right, so that's sort of the big question that motivates this investigation. And taking a look at the various measures that have been proposed and the sorts of things that are in Dodd-Frank, I think it's useful to organize the proposals that are being put forward into two broad categories of ways to avoid government bailouts of banks. Make bank failures less disruptive, or make bank failures less likely. So let me start here on the left for a moment. Why do governments feel compelled to step in and bail out banks? Well, there's a fear that a failure of a large financial institution would be very disruptive to the rest of the economy. So one way to lower the likelihood that the government will step in is to make it less disruptive to let a large financial institution fail. And so among the things you have in Dodd-Frank is a requirement that large financial institutions will have to create living wills, which basically specify how they would be broken up, an expanded resolution authority for the FDIC. All of that is to kind of streamline the process of the failure of a large financial institution so that you don't have the fear of a very disruptive and prolonged bankruptcy proceedings. My focus is over here on the other side, make bank failures less likely. There too, I think it's useful to break that category into two subcategories. How do you make bank failures less likely? Well, you try to make banks less volatile, make them boring utilities, or make sure banks can absorb more losses. So some of the measures that try to make banks less volatile are, for example, the Volcker rule, which preclude banks from proprietary trading, owning hedge funds or private equity firms. Some of the new derivatives rules are also intended to basically make banks less volatile. And then finally, in that corner over there, is trying to make sure that banks can absorb greater losses. And probably the biggest measure there are the new capital requirements under Basel III, and I'll say a little bit about that. And then finally, contingent capital falls into the category of ways of trying to make it possible for banks to absorb more losses. All right, so to talk about contingent capital, I need to say just a little bit about capital requirements. So banks are subject to minimum capital requirements. I think it's more useful to interpret a minimum capital requirement as an upper bound on leverage. It really sets an upper bound on how much leverage a bank can have. The capital requirements are long and complicated, but the most important feature is the banks need to hold capital equal to 8% of risk-weighted assets. Okay. So what does Basel III do? Basel III sets higher standards on what counts as capital, so more emphasis on common equity as opposed to other forms of capital. So it tries to improve the standards on quality of capital, and it also changes the risk weights so that the net effect is that banks will end up holding more capital. Now, if you want to make banks really, really safe, why not just set these capital ratios very high? Just have banks hold even more capital. Well, so the argument is that equity is expensive, and maybe more importantly, there's a concern that high capital requirements in the financial system may reduce economic growth. So yes, you'd end up with very safe banks, but maybe it comes at the expense of reduced economic growth. So there's a reluctance to set capital requirements too high, and that's where contingent capital comes into play. So the promise of contingent capital is capital when you need it. So you don't have it tied up in banks in good times, but somehow it automatically gets injected into a bank when a bank gets in trouble. And in particular, the flavor, the most important one, and the one that we're looking at here, is debt that converts into equity when a bank starts to get in trouble. Okay, so you let the bank have more debt, but then if it starts to get into trouble, the debt converts into equity. All right, there have been some actual issuances to date. So the first important one was by Lloyds Banking Group in November 2009. introducing the so-called COCO bonds. So these are contingent convertibles, but it's exactly debt that converts to equity. Now, that was part of a debt swap with existing investors, so it wasn't exactly a sort of open market transaction, arm's length transaction. There was a very similar transaction shortly after as part of the merger of two British mortgage banks, Yorkshire and Chelsea Building Society. Rabobank is an example of a different flavor of contingent capital. Rabobank has no publicly traded equity, so you can't have debt that converts to equity, but they have debt with an automatic write-down feature if the bank starts to get in trouble. And then last week was a big week for COCOs. Credit Suisse issued $2 billion of what I think will eventually be $7 billion of these contingent convertibles, and Barclays announced that they're going to start paying their bonuses to their own employees in their own COCOs. So the employees will own debt securities that are convertible to equity. So in a sense, the employees would be bailing out Barclays to some extent if Barclays were to get in trouble in the future. I think it's important to note that these ideas have some important academic pedigree. In particular, Mark Flannery had an early paper proposing this kind of mechanism. There's been quite a bit of other work lately. I've mentioned their Squam Lake Working Group, which was a group of academics who've also proposed a version of this. So some of these actual specific mechanisms were, to some extent, anticipated in academic research. Now, one thing, just to plant the seed, I'll come back to this later, what do all these financial institutions have in common, all the actual issuances to date? Well, one thing they have in common is that none of them is a US-based institution. These are all European banks, and that's not accidental. Okay, so what triggers conversion of debt to equity? So I said the idea here is that you're going to have the debt convert to equity when a bank gets in trouble, but what does it mean for a bank to get in trouble? There are basically two broad categories of triggers. There are regulatory or accounting-based triggers, based on a regulatory or accounting-based capital ratio. So remember, I said before that there's a requirement a bank has to hold a minimum capital level, so there's 8% of risk-weighted assets, and under a capital ratio trigger, debt converts to equity when you hit that minimum requirement. The alternative is some sort of market-based trigger, like, for example, the bank's stock price or credit default swaps on the bank. Now, each of these has advantages and disadvantages. I think the main advantage of the regulatory capital ratio trigger is that, well, that's how capital requirements are specified, so it sort of naturally would make sense that conversion would be based on maintaining the regulatory standard. The main criticism of anything that's regulatory and therefore accounting based is that it's backward looking and slow to respond, right? So by definition, anything that's based on accounting information is going to be backward looking. Another concern is that this may be subject to accounting or political manipulation. So on the accounting side, a financial institution has some influence over exactly how things get reported, and there might be a temptation to skew that. Actually, perhaps a bigger concern is political manipulation. If it's up to a regulator to come in and state, okay, this debt is now going to convert to equity, possibly creating a lot of fear in the market, there may actually be a real reluctance on the part of the regulator to declare that a bank is facing that sort of trouble because of the consequences. So there's actually some concern that the regulator would be reluctant, not too quick to announce, but reluctant to announce that a capital ratio has been breached. I want to stress, however, that all actual examples to date, and I would say all actively considered examples, are in this category of regulatory-based triggers, accounting-based triggers. The alternative, I think, has some academic appeal in particular, and this was Mark Flannery's original paper contemplated this point of view. The idea of a market-based trigger is that, well, maybe the market knows better than the regulator whether a bank is in trouble. And so this is forward-looking information, right? You think of the stock price conveys information about the future prospects of the financial institution and is quick to respond. Now, maybe too quick, right? You could have, for example, a flash crash that drops the stock price of a bank accidentally too low, and maybe that triggers a conversion. Various kinds of things could happen. You might have just you might be too prone to a false alarm. And there's also a concern that this may also be subject to market manipulation. So you could imagine that you'd have some people shorting the stock to try to drive the stock price down to force conversion of the debt to equity. That sort of thing is what people are concerned about. The second project that I mentioned with Sundaresan and Wang builds on work they have done. So they've pointed out some theoretical complications that come up with a market-based trigger. And so the other stream of work I referred to is some follow-up work to the work that they had done previously. But today I'm talking just on the capital ratio trigger. All right, so what's the goal of this paper? I was thinking about how to describe that to this audience. And so here's how I'm putting it. The idea is to come up with a Black-Scholes type formula for contingent capital with a capital ratio trigger. Okay, so assume you're familiar with the Black-Scholes formula, sort of the standard formula for pricing an option. Now that may sound a little bit presumptuous to say that I'm trying to come up with a Black-Scholes type formula for anything. I mean that in both a generic sense and a specific sense. So let me just elaborate a little bit on that. So the generic sense is that it's an arbitrage-free valuation formula. So we're going to try to value contingent capital from the point of view of a no arbitrage argument as the original Black-Scholes formula. And a valuation formula, the goal is to help us understand how key inputs to the model determine value, in this case through the fair yield. So actually we're not trying to so much price the debt as calculate what is the fair yield on this debt. And the value of coming up with a formula is to help you understand how the inputs affect the outputs. And what are the key inputs here? Well, the asset volatility ends up being a very important one. And if you're familiar with the Black-Scholes formula for option pricing, it's not surprising that volatility is going to be important. The required capital ratio ends up being important. The maturity of the debt, yields on senior debt, and the risk-free rates, treasuries. And then what assumptions you make about recovery rates in the case of failure. And I should say that just up front that one of the challenges ultimately in using this kind of approach is that some of these things are not really directly observable. Certainly recovery rates are not going to be directly observable. And asset volatility is not going to be directly observable. So that's sort of the generic sense in which you could think of almost any valuation formula as being analogous to the Black-Scholes formula. There's also a more specific sense in which I want to make a connection with the work of Black and Scholes. In their 1973 paper, they were not really interested in pricing options. That was not the focus of the paper, although that's certainly lived on very successfully. They were interested in valuing corporate debt. So what's the connection between options and corporate debt? Well, the key observation in that connection is that equity is a call option on the firm's assets. Right? If the firm's assets gain value, the equity holders grab the upside. If it goes down, they just walk away. So they have a call option on the firm's assets. And risky debt, and this was the connection with corporate debt in their paper, you can think of corporate debt. It's like riskless debt minus a put option on the firm's assets. Okay, the debt holders are short a put option on the firm's assets because the equity holders have the right to put the firm to them and just walk away. So there's this connection between the capital structure in the firm and this option pricing formulation. This is often referred to as a structural approach to valuing corporate debt, and it's got a long line of work subsequent to Black and Scholes. Some important papers there are Merton, 74, Black and Cox, 76, Leland, 1994, and there's been quite a bit of work subsequently. And that's the perspective that we adopt in trying to value the contingent capital. So we're looking at it as a contingent claim on the assets of the firm. So I'm just going to sort of walk you through. I'm not going to show you any formulas, don't worry, but I'm going to just draw some pictures here. All right, so I'm just going to draw some pictures to show you how we're thinking about this in this structural view. All right, so we're going to start here at time 0. We've got 112 in asset value, and we've got $90 in debt. Okay, so the difference there is the equity. And I'm going to start off in a world with no contingent capital. And to make the numbers nice and round, I've got a 10% capital requirement. Now, 10% capital requirement, if I've got $90 of debt, means that I've got to have at least $100 in asset. Because at $100 in asset, my capital, the difference between those two, the equity capital, is 10% of the assets that I hold. Okay, so that's the lowest asset level I can sustain if I've got $90 of debt. Okay, so as assets fluctuate, if I hit that boundary, once I cross that boundary, I've violated my capital requirement, and you can think of I've been seized by the regulators. Okay, now we replace, out of this $90 of debt, I'm going to replace 30 of that with a tranche of convertible debt. Okay, so now I've got $60 in senior debt and $30 of convertible debt. Okay, by the same argument, I can go up to 66.67 with this amount of debt. If my asset value fluctuates to 100, okay, at that point, if nothing happened, again, we would violate the capital requirement. So at this point, conversion begins, and we start converting debt to equity. We convert just enough to maintain the capital ratio. Now, if the asset value starts to recover, the equity does not convert back to debt. Once it's converted, it stays converted. All right, and now if we have more conversion, eventually, at this point, the contingent capital has been exhausted. And at that point, again, there's nothing you can do. The capital ratio is violated. The bank is seized and liquidated. But it happens, you can sustain a much greater drop in asset value as a result of having this convertible tranche there. Okay, so what does it mean now to value this convertible debt? Well, we've got to value the various elements of it, and there are 4 pieces of it. So there's the coupon payments that you earn on the unconverted debt. There's the principal payment on the unconverted debt. There's the dividends earned on equity after conversion. So you've got 2 pieces of the debt, and then you've got 2 pieces on the equity. There's the dividends earned on the equity after conversion, and then there's the final value of earned equity at maturity. So while I said it's sort of trying to come up with a Black-Scholes formula for the whole thing, it's really like 4 different Black-Scholes formulas, one for each piece, each stream of cash flows. All right, so I'm not, I guess I won't walk you through the various pieces, the coupon, the principal, the dividends. Let me just maybe show you a little bit about what comes out of this kind of valuation approach. So here what we're showing is what is the fair yield on the contingent capital as a function of the volatility of the assets of the firm at 3 different levels of the capital ratio. So the minimum capital requirement, this alpha here, 1%, 4%, or 6%. Why don't I have 8% up there? Well, remember, it's 8% of risk-weighted assets. Risk-weighted assets are lower than total assets. So 8% of risk-weighted assets would be something like 6% of total assets. And if you think of a volatility, reasonable volatility would be in the range of, say, something like 8 to 10%. And if we're looking at a capital ratio of about 6%, that more or less gets us in the ballpark. The Credit Suisse CoCo issue had a coupon of 7.75%. So we're sort of in the right range here with this valuation formula. Some of the other interesting features that come out of this that I think are not entirely obvious is that the dependence of volatility is not monotonic. So you can see it both goes up and goes down as a result of this debt having both equity-like and debt-like features. So that's why you get this, I think, perhaps somewhat surprising dependence on the level of volatility, and similarly on the capital ratio because of the hybrid structure. Let me, in the interest of time, I think maybe just skip ahead here to some general conclusions. So what are the things that we get out of this model? Well, asset volatility and recovery rates are the main drivers of yields. I mean, that's perhaps not entirely surprising, but we're able to quantify that. The effects of volatility and the minimum capital ratio are, as we saw in that one example, not monotonic because of this hybrid nature of having both debt-like and equity-like features. One of the other things that I would say, one of the main takeaways of this analysis is that the yields turn out to be very sensitive to model inputs. And that's bad news because, as I said before, some of these things are not really observable. And then one of the other pictures there showed that a thin layer of CoCos won't work. Basically, the yield required is just going to be too high. What are some of the issues here going forward? Well, the reason none of the examples to date has been in the US is because under US tax law, the coupon on that convertible debt is not tax deductible, but it is in Europe. So there's much greater incentive. So this looks much more attractive in Europe than in the US. I think there's a real question about whether these types of securities are really just too complex. Do you really want to have the financial system relying on something that may be too complicated to understand? There's this debate over what the trigger should be, as I mentioned before. I think there's also a big question about whether the hybrid market is large enough. You have an equity market and a debt market of investors that tend to be quite separate from each other, and here you're trying to market something that has elements of both. Where we may end up is with what's called gone concern contingent capital rather than going concern contingent capital. The idea being that in a gone concern contingent capital, basically the debt would only convert to equity essentially at the time that the institution is failing, as opposed to as a way of keeping it in business. Thank you.